ultimately, when we're producing alpha ideas, we're looking at stocks. We're looking at stocks that not only have a return that we can quantify and measure. We have our own models that build and design our ability to forecast stock returns on a daily basis, updating over lots of different time horizons. But everything is really about expected return. What are we expecting anything to pay off for us? And so the process that we follow is to say, let's not just look at the return that's available. Let's understand how we're managing the risk simultaneously with that, because obviously the kind of return that you're going to get from owning Nvidia is a very different kind of return you're going to get from owning General Motors. And sometimes it's useful to have that return and just lock it away in your portfolio and then come back 6 months or 12 months later. We all talk about alpha, but there's always a measure of beta. In other words, what's the market expecting from a company? And is there a way that if the market is expecting a particular return from a stock, we can identify which stock actually have a higher or lower degree of risk in relation to that? And therefore, we could have a stock that looks good on paper, but in reality is far too expensive in the short term or far too cheap in the short term. And that's really what we're trying to pick up. We're trying to identify where, out of a large universe of stocks, any universe of stocks, we can find those extra value added.